Joining us right now is Saira Malik, who is Chief Investment Officer at Nuveen. And Saira, how do we read this? A stronger economy, which has to be good news for stocks, but for anybody who was counting on a cut in interest rates, don't hold your breath.
Hi, Becky. So these employment numbers throw a monkey wrench into the disinflation narrative for two reasons. One, average higher hourly earnings, which are up 0.6%, and also the work week numbers, which are down 0.6%. So what does that mean for investors? Well, first of all, the Fed, it pushes out rate cuts likely till the second half of the year. Our call has only been for 3 to 4 rate cuts this year because of elongated inflation. Looking at the markets, tech has been leading here. We're just passing through the biggest week for tech earnings. My question is, what is the catalyst to take us further? It's going to be challenging unless market returns can broaden out, which I think will be a headwind and difficult for markets to do. And finally, we saw how fragile the markets can be this week. Just go back a couple of days when the FOMC threw water on that first March rate cut. Markets declined, and also with the mini banking crisis with New York Community Bank, we saw markets swiftly react negatively to that. All of that, I think, makes it tough for the market to find reasons to rally from here, especially given today's number.
Ron Krzyzewski was with us earlier this morning. Stifel thinks that we're at the high watermark for the S&P 500 this year just because they think earnings are only going to come in up about half the range that the street's expecting at this point. I guess a lot riding on earnings.
Well, our price target for the S&P 500 for this year was 4,950. So I agree that there's not a lot of upside. The key question is going to be, can this economy continue to hold up in the face of higher interest rates and higher inflation? What we're seeing today is, yes, it can, but under the hood, we do have consumer delinquencies increasing. That's an issue. Credit card delinquencies are up at these high interest rates. Manufacturing data starting to recover is promising, but earnings, the driver's been tech stocks, and I think a lot of haves and have-nots in the technology companies, from Apple on the negative side to Meta and Amazon winners. And whether that can continue again like it did last year is pretty questionable to us. I think we're getting at valuations levels where we have to think, what is it that can take this market higher? I don't see that catalyst.
Look, a stock like Meta, though, up because of those incredibly strong earnings reports. And again, if you tie it back to earnings, if they can deliver, hard to not reward them.
I agree. And these tech companies did a great job normalizing post-COVID. They invested heavily in their workforces. They are cutting back to meet more of a normal environment. Amazon, a winner because it invested heavily in logistics, which is manufacturing, which we're bringing closer to home. So Meta, Amazon winners. But you're also seeing Apple, which is having a challenging time normalizing post-COVID, higher regulations in their app store, difficulties in China. Some of these mega caps also, are on the flip side. So we need to be more selective with technology stocks, and also just finally touching on that second half of this year with elections coming around the world, 77 elections this year, 60% of GDP going to the polls. If you look at years when the U.S. election as a leader, when the results are going to be close, markets tend to be more volatile to the downsides. I think that could be another headwind for the second half of this year.